We're in a digital economy now, and Bitcoin could become the new standard for the digital economy in the future, replacing gold in that function. So I think Bitcoin, and I've tracked this versus the dot-coms. I compare the cryptos to the dot-coms in the late 90s. It wasn't just a bubble in tech stocks, it was the dot-coms, Amazon, okay? Amazon was a nothing burger and became the greatest retailer in history. So this is going to crash, and I think Bitcoin could go down to 3,000 to 7,000 and then go to 500,000 to 1 million in the next global boom. So that will be the buy of a lifetime, but I wouldn't touch it with a 10-foot pole, even down 50%, 60% here.
All right, I want to break that down a little bit. So Bitcoin goes down to around 3,000.
3,000 to 7,000, yeah.
In the next
2 years.
2 years.
In the global crash,
where
all financial assets, and Bitcoin is a new financial asset. It's like the dot-com.
But ultimately, you see Bitcoin going to $500,000.
$500,000 to $1 million.
By 2037?
Yeah, and you know what? That would be enough for it to overtake gold as a global standard for money.
When you say global standard, do you see fiat currency being pegged to a Bitcoin standard? What do you mean by that?
It could be. I mean, you have to peg to something. I mean, here's the thing. This crash, after the greatest bubble in history, when everybody took off the shackles, is going to show that you can't just print money and grow, okay? And everybody's done it. U.S. is not the worst player here. Europe and Japan are worse. When this crashes, it's going to say, we need a new standard. We need something real, and we need something for the digital realm. Gold is not that. I think gold will grow to 3,000 to 5,000 in the next boom because Indians love gold. They like it as jewelry. Indians wear jewelry in places we can't even imagine.
Okay.
They wear more jewelry compared to their income than anybody I've met in the world.
So Indians love gold, but the globe is going to love Bitcoin long term.
Bitcoin is going to be the new digital standard, I think, for money. And that's the standard. So other things, crypto, are innovations in finance. But I think Bitcoin becomes the global standard. It's not there yet. It's not big enough. It's not widely accepted. And I think it'll crash the most. I think Bitcoin, like I said, 4,000 to 7,000 from 69. That'll crash more than stocks. That's what I would. If we have this crash, I'm predicting in the next 2 years, the number one thing I'd buy would be Bitcoin or Ethereum coming out of it.
Number one thing you'd buy Bitcoin and
That's
Ethereum.
the next new wave, like the dot-coms, like Amazon were in the 2000, 2002 crash.
Okay.
You know, Amazon went from 6 to 136 in 2 years and back to $6. That would have been the buy of your lifetime back in 2002.
Harry, the last time we spoke, when you made this forecast, we didn't have the factor of Russia's invasion of Ukraine. That has since happened, and not really according to Putin's plan. It's dragged on quite a lot longer than he expected. We've also got Finland and Sweden saying that they want to join NATO. Putin's latest comments have been that he's seemingly okay with that, provided that they don't get military strengthening from other NATO countries. We still don't really know how this entire conflict plays out. How does this fit into your forecast, other than being potentially a useful thing for the Fed to blame things on?
Yes, I see it as a trigger, okay? You know, when things are going up and up and up, people need to see something's going wrong to make them at least think twice about high valuations. We've never seen real estate this overvalued, way more, or stocks, even almost like 1929, but real estate is the most overvalued in history everywhere. You need something to say something's wrong to get people to think. So it's a trigger for this collapse. It will not be the cause of this collapse in financial assets.
But how do you see this conflict playing out? I mean, it's been useful.
I see
in terms of the Fed having something to blame.
Putin has the worst timing in history to do this. He's being aggressive at a time when the world not only does not want it, but the world can go into a downturn, and he could be blamed for triggering the downturn, even though it wasn't really him. So I think it's the death of Putin. I think Putin has bad timing here, and I really wish, instead of just, you know, advising financial advisors and investors, I wish I could advise governments, because these economic downturns would tell you to do things differently.
But do you see a diplomatic off-ramp for this conflict? How do you see this conflict resolving itself?
I see Putin got aggressive because he saw an opening.
Right.
And he wants to take over everything he can of the old Russian Empire, and he did it at the wrong time, and he's going to be punished for it. He's already being punished for it in public opinion globally. And when the economy goes down, they're going to blame it on him for triggering this downturn.
So, but do you see him just pulling his troops out of the Ukraine? Do you see him becoming potentially more aggressive and upping the ante?
No, actually, in the downturn, he might become more aggressive because the world's distracted by everything else. So, yeah, I think Ukraine's already kind of he keeps taking over his satellite nations around him. He's going to keep doing that. But I think it's going to go down as a bad move for him historically. He's not going to be looked like he was smart to do this.
Right, but is there a way for this to end in a somewhat, shall we say, peaceful resolution?
Only because the world goes into a global, mark my words, not recession, depression, like the early 30s, and everybody says, who cares about this?
Okay.
In other words, it's no longer a big issue.
Well, what about commodities? Because prior to our conversation, this didn't happen, and now we have been seeing a big rally in agricultural commodities, concerns of food shortages. How does that factor into the everything bubble? Because people are still going to need to eat.
Yeah. But commodities bubble more than anything. The difference between
but soft commodities.
Okay, difference between commodities and stocks. Commodities have already crashed, and then they're in a rebound. They go back down to new lows. The CRB, Commodity Resource Board Index, will go to new lows by my forecast, something like 100, but it will not go down as much as stocks, which are at new highs. Commodities are not at new highs. So commodities continue to go down just because the world slows and people spend less on everything, including basic stuff.
Okay. Well, Harry, ahead of this interview, I asked our viewers to send in some questions. And one of the top questions, and you've kind of touched on this already, was your outlook on the US housing market, which you said is also going to be part of this crash. So elaborate on that.
Well, number one, it's the biggest part of the crash. Most people don't own that much in financial assets like stocks, in their 401k plan. They own some. Everybody owns real estate in the United States. Everybody that can afford to does. So when real estate goes down...
Millennials don't. That's been part of the problem. They can't afford a home.
Well, they're the winners here. The millennials are going to kiss the ground when this happens, what I'm saying, because real estate will go back down to 2008 to 2012 levels, the lows we saw after the last crash. And remember, stocks crash quick. Real estate took years to hit a bottom, really mostly 2010 to 12. Real estate will go down at least to those levels and become affordable to the millennials for the first time in their lives. They're the winners. Guess who the losers are? People like me, baby boomers who've invested in real estate and keep saying you can't go wrong buying real estate, own real estate, and real estate goes down. Now, last time, 34%. Even the Great Depression, 26%. This is the biggest decline. This will be 40 to 50% in real estate. We've never seen that before. That'll be a shock.
Is there any development or scenario that will make you reconsider your forecast?
No. What you have to, once you get a bubble, it has to deflate, and bubbles never deflate slowly. Everybody says we can have a soft landing. There is no soft landing anywhere in history to a major bubble, but it can be deferred a bit and then come down later. So I will not be happy and say people invest again until I see this bubble deflate. And I have my targets in stocks, in real estate, and I have all my targets. If we get to these targets in the next few years, I'll say you can invest for the long term again. Right now, if you are invested in financial assets, you are going to lose a lot of money, I think, in the next 2 years.
All right, so as we wrap up, I'm sure our viewers would like to know what your targets are for those particular assets.
Okay. I think the S&P 500 brought in is going to go down 86%. That's
right.
670. It's been up to almost like 4,800 at the top, okay? Real estate down 40 to 50%. Last time it was 34%. This is what hits people the most. When their home goes down in value and they're underwater in their own home and can't even borrow against their own equity. So that's my forecast. And commodities go down even lower. And gold goes to about 900 to 1,000 in the crash and then zooms in the next book.
And when all of those low targets are met, that's when you're saying it's safe to jump back
Yes.
into the water.
Only when things get back to reality, which they are nowhere near. So everybody thinks, well, the Fed keeps doing this. No, we're in a bubble that's already so extended. There's nothing the Fed can do except extend this a little longer. The only way to get back to normal is to have a crash. There's no other way to get there.
Harry, how are you positioned right now then?
Treasury bonds.
Just Treasury bonds?
Just Treasury bonds. Now, normally in good times, you diversify in these risk assets, stocks, bonds, and real estate stuff. In this, there's only one thing. Everything. Again, my statement is, without any qualification, this is the greatest financial asset bubble globally in all of history, and it has to come down, so all financial assets come down except the very safest, which is only the Treasury bonds of the best governments, and especially bad house and a good house in a bad neighborhood, the U.S. Treasury bonds. The only place I'd put money. Otherwise, and if you're too scared to do that, just be in cash. Just go to cash. Everything will come down and your cash will buy more of all financial assets. But I like the Treasury bonds. They go up. In 2008, they went up.
All right, so cash or U.S. Treasury bonds is your best advice to ride out what is going to be the ugliest equity crash.
And if it doesn't happen by the end of 2023, then I'll shut up.
Okay.
That's the end of my bad cycles where it's most likely to happen.
So if...
What you guys do you think about this? Let us know your thoughts in the comments.